The Baht heard round the world. Asian financial crisis, 1997. It is July 2nd, 1997. Bangkok, Thailand. In the morning, the Bank of Thailand makes an announcement. The baht, Thailand's currency, pegged to the US dollar since 1984, the anchor around which 13 years of extraordinary economic growth have been organized, is being allowed to float. The announcement is delivered in the measured language of central bank communication. Carefully worded, professional, the kind of statement that experienced currency traders read in seconds and immediately understand to contain, behind its careful language, something much simpler and much more devastating. We have run out of ammunition. We cannot defend the peg any longer. We are surrendering. Within hours, the baht has fallen 15% against the dollar. Within weeks, 40%. Within months, the contagion has spread from Thailand to every significant economy in Southeast and East Asia, Indonesia, South Korea, Malaysia, the Philippines, currencies collapsing, stock markets crashing, banking systems insolvent, the IMF arriving in capital after capital with emergency loan packages and conditions, riots in the streets of Jakarta, a South Korean president going on national television to ask his citizens to donate their gold jewelry to help replenish the national reserves. Think about that for a moment. 2 million people handing over their gold, from their homes, their jewelry, their family heirlooms, donated to the government, to help cover a foreign currency shortage caused by a financial crisis that the people doing the donating had no part in creating. There is a man at the center of this story, at least in popular imagination, named George Soros. He made $1 billion shorting the British pound in 1992. He made more shorting the baht in 1997. He did not create Thailand's vulnerability, but he identified it, bet on it, and in doing so, accelerated and crystallized a crisis that the structural weaknesses of an entire region had been building for years. Welcome to Market Mayhem. When greed meets gravity, I'm your host. Today, the most devastating regional financial crisis of the 20th century, the one that broke the Asian miracle, the one that proved that in a world of free capital flows, a currency peg is only as strong as the speculator's willingness to leave it alone. Episode 12. Let's begin. To understand the Asian financial crisis, you need to hold two things in your mind simultaneously. The Asian miracle was real. The financial architecture that financed it was a trap. Both of these things are true. And understanding how they were true simultaneously is the key to understanding how a region that had achieved something historically extraordinary, decades of sustained high growth that had lifted hundreds of millions of people out of poverty, could collapse with such speed and such violence. The growth was genuine. Through the 1980s and into the 1990s, Thailand, Indonesia, Malaysia, South Korea, and the Philippines had sustained GDP growth rates of 7, 8, 9, sometimes 10% per year. Growth rates that, maintained over a decade, were transforming living standards at a pace unprecedented in economic history outside Japan's post-war reconstruction. The mechanisms were real. Manufacturing was expanding and becoming more sophisticated. Export industries were internationally competitive. Educational levels were rising. Infrastructure was being built. Foreign capital found it irresistible, and it poured in. It poured in through two channels, and the difference between those channels is the key to understanding why the crisis was as bad as it was. The first channel was foreign direct investment, factories, manufacturing facilities, supply chains, the physical infrastructure of an industrial economy. This money was slow to arrive and slow to leave. You cannot pack up a factory and move it overnight. FDI was the slow, sticky, durable form of financing that underpinned the genuine economic development of the region. The second channel was short-term foreign currency borrowing. Western and Japanese banks, looking for better returns than they could find in their home markets, lent dollars and yen to Asian banks, which then lent the proceeds in local currency. The Asian banks were borrowing short-term in foreign currency and lending long-term in domestic currency. This is, in the vocabulary of banking risk, the most dangerous possible combination of mismatches: currency mismatch and maturity mismatch simultaneously. The currency pegs were what made this structure seem safe. Thailand, Indonesia, and the Philippines all pegged their currencies to the dollar within narrow bands. South Korea operated a managed exchange rate. The pegs provided what looked like currency certainty. Foreign banks lending dollars to Asian banks could assume that when the loans came due, they would be repaid in dollars worth the same number of local currency units they had originally converted from. The currency risk, on this view, had been engineered away by the peg. But the peg created a structural trap. The very certainty it provided encouraged dollar borrowing at a scale that the countries involved could not manage if the peg ever broke. As the dollar strengthened through the mid-1990s, taking the pegged Asian currencies with it, export competitiveness declined. Current account deficits widened. The real estate and stock market bubbles that had been inflating on cheap dollar credit grew larger, and the banking system's dollar-denominated liabilities grew ever more precarious relative to their local currency assets. The macro hedge funds, the investors who analyze these structural vulnerabilities across entire economies and bet on when they will break, were paying attention. George Soros had done this before. In September 1992, in what became known as Black Wednesday, his quantum fund had attacked the British pound, a currency the UK had fixed within the European exchange rate mechanism at a rate that the British economy, after German reunification and the resulting interest rate pressures, could no longer maintain. The Bank of England had spent billions of pounds buying its own currency to defend the peg. Interest rates had been raised to 15% in a recession, in a desperate attempt to make holding pounds attractive. Nothing worked. Soros had sold pounds short, systematically and at scale. When the Bank of England's defenses were exhausted and the pound was devalued, he covered his position and made approximately $1 billion in a single day. The mechanism was the same in Thailand 5 years later. The analysis was the same. Identify a currency peg that is misaligned with economic fundamentals. Identify the central bank's reserve level and the rate at which it is being depleted, defending the peg. Borrow the target currency. Sell it in the foreign exchange market. The central bank must buy it, spending its reserves to maintain the peg. When the reserves are gone, the peg breaks, the currency falls, and you cover your short at the lower price. The elegance of the trade is that it is self-reinforcing. Every dollar the Bank of Thailand spends defending the baht is one less dollar in reserve. Every dollar less in reserve is one step closer to the inevitable. The speculator does not need to be certain the peg will break. They just need to be confident that the cost of defending it will eventually exceed the reserves available to defend it. In Thailand's case, the structural vulnerabilities were clear to anyone looking carefully. The current account deficit had reached approximately 8% of GDP. Real estate in Bangkok had massively overbuilt, with vacancy rates rising and developers increasingly unable to service their loans. The banking system had borrowed short-term in dollars and lent long-term in baht to property developers and industrial companies, whose assets and income were in baht. This mismatch would be catastrophic if the peg broke. The Bank of Thailand knew it was under attack. From early 1997, it was spending reserves defending the baht. By the time the peg was abandoned on July 2, 1997, Thailand had spent approximately $23 billion of its usable reserves trying to maintain a rate that the market had decided was unsustainable. $23 billion gone, and the peg broke anyway. Mahathir Mohamad, the Prime Minister of Malaysia, whose country would be swept up in the crisis within weeks, went on television and accused George Soros by name of deliberately destroying Asian economies for personal profit. He called currency speculation immoral and unnecessary. He was furious and eloquent, and deeply, personally offended. Soros responded that he had not created Thailand's current account deficit, or its banking system's dollar mismatch, or its overbuilt real estate market. He had identified a structural vulnerability and bet on it. He was right. Whether being right about the vulnerability makes the attack legitimate, or whether the act of shorting a currency accelerates a crisis that might have been managed more gradually without the speculative pressure, is a debate that international economists have not fully resolved in the decades since. Both sides have serious arguments. What is not debatable is what happened next. The baht's devaluation on July 2nd was not just Thailand's problem. Within weeks, it was the entire region's problem. The mechanism of contagion in 1997 was not primarily economic linkage. Thailand was not Indonesia's largest trading partner. Korea was not directly exposed to Thai real estate. The contagion spread not through trade or financial exposure in the conventional sense, but through investor behavior, through the sudden, simultaneous recognition that the structural vulnerabilities that had broken Thailand existed in varying degrees and different forms across the entire region. Every investor who had lent dollars to an Indonesian bank, a Malaysian corporation, or a South Korean chaebol looked at their exposure with new eyes after the baht broke. The Thai bank that had borrowed short-term in dollars and lent long-term in baht, and was now technically insolvent because the baht had collapsed, was not uniquely Thai. It was a template, and the template had been replicated across Southeast and East Asia for a decade. In Indonesia, the rupiah was under immediate pressure. President Suharto's government, which had ruled Indonesia for 30 years, through a combination of genuine development achievement and authoritarian control, found itself confronting a currency crisis for which it had no playbook. The rupiah fell, then fell further. By January 1998, the Indonesian rupiah had lost approximately 80% of its pre-crisis dollar value. 80%. In 6 months. In an economy of 200 million people. The consequences in Indonesia went far beyond financial. Prices of imported goods, food, fuel, medicine, rose dramatically as the currency fell. Millions of Indonesians who had been lifted out of poverty by the preceding decade of growth found themselves sliding back. Riots erupted in Jakarta in May 1998. Shops owned by the ethnic Chinese community, scapegoated horrifyingly and unjustly for the economic crisis, were attacked and burned. Suharto, his authority collapsing as rapidly as his economy, resigned in May 1998 after 32 years in power. South Korea's crisis was, in some ways, even more dramatic in its speed and its symbolic weight. South Korea was not a small developing economy. It was the world's 11th largest economy, home to Samsung, Hyundai, LG, globally significant corporations that had competed successfully with the world's best. Its crisis came not from a currency peg in the Thai sense, but from the specific vulnerability of the chaebols, the enormous family-controlled industrial conglomerates at the heart of the Korean economy, which had borrowed heavily in foreign currency to finance their expansion. When short-term dollar lending froze in the wake of the Thai crisis, They could not roll over those loans. In December 1997, with Korea's foreign currency reserves nearly exhausted, President Kim Young-sam went on national television. He asked the Korean people to donate their gold, their jewelry, their gold savings, their family heirlooms, to help replenish the national reserves depleted by defending the won. 2.2 million Koreans responded. 225 tons of gold. The IMF arrived with a $58 billion rescue package, the largest in history at that point. The conditions, as always, were austerity, structural reform, and the opening of previously protected sectors to foreign competition. By 1998, the regional crisis had cost Southeast and East Asia an estimated $600 billion in lost economic output. Millions of people who had been climbing out of poverty for a decade were pushed back in. The aftermath of the Asian financial crisis reshaped the economic architecture of the region in ways that are still visible today. The most significant long-term consequence was the determination of Asian central banks, traumatized by the sight of their reserves being depleted, defending currency pegs against speculative attack, never to be in that position again. In the decade following 1997, Asian central banks accumulated foreign exchange reserves on a historically unprecedented scale. China, South Korea, Taiwan, Singapore all built reserve positions far in excess of any conventional measure of what was needed for precautionary purposes. By 2007, China alone held over $1.5 trillion in foreign exchange reserves, up from minimal levels in the early 1990s. This reserve accumulation, the direct consequence of Asian governments deciding collectively never to be vulnerable to a speculative attack again, contributed significantly to the global savings glut of the 2000s, which in turn contributed to the low interest rate environment that helped build the conditions for the 2008 financial crisis. The Asian crisis's aftershocks reached across a decade and across the world in ways that nobody standing in Bangkok in July 1997 could have anticipated. South Korea's recovery, when it came, was remarkable. The country restructured its corporate sector with unusual willingness to confront painful realities, built world-class financial institutions, and eventually emerged from the crisis stronger than it had entered it. Samsung, Hyundai, and LG today are different companies from the ones that existed before 1997. More financially disciplined, more internationally competitive, and in important ways more capable. Thailand's recovery was slower. Indonesia's was slower still, complicated by the political transition from the Suharto era and by the particular depth of its economic contraction. Malaysia, which had controversially imposed capital controls in 1998 to prevent further speculative pressure on the ringgit, a decision the IMF condemned and economists still debate, performed reasonably well in the years that followed, though the counterfactual is impossible to establish with certainty. The 2 million South Koreans who donated their gold got it back, denominated in government bonds. Whether that exchange was fair, given what they donated and what they received, is a question that resists simple calculation. The Asian financial crisis teaches 3 lessons about currency markets, structural vulnerability, and what contagion actually means at the level of institutional behavior. The money lesson is about currency mismatch, the specific, deadly structure of borrowing in one currency and earning or owning assets in another. Thai banks had borrowed dollars, which they were obligated to repay in dollars, and had lent baht, which would be repaid in baht. As long as the dollar-baht peg held, the mismatch was invisible and manageable. When the peg broke and the baht fell 40%, those banks' dollar liabilities were suddenly worth 40% more in baht terms, while their baht assets had not changed. The insolvency was instantaneous and mathematical. It did not require any new bad decisions or any new bad luck. It was baked into the structure the moment the peg was defended past the point of sustainability. In modern trading, whenever you hold a position funded in a different currency from the underlying asset, you are running a currency mismatch. It is manageable as long as the exchange rate is stable. It becomes catastrophic if it isn't. Always model explicitly what a 30% currency move does to the economics of your position. The method lesson is about what makes a peg vulnerable to speculative attack and what does not. A currency peg supported by strong fundamentals, sustainable current account, abundant reserves, a banking system not reliant on foreign currency funding, can withstand speculative attack. Speculators who attack it will simply lose money as the central bank defends successfully. A peg fighting against fundamentals, large and growing current account deficit, depleting reserves, currency mismatched banking system, will eventually break regardless of how committed the policy is, because the mathematics of defense are ultimately unsustainable. Soros and the macro funds did not create Thailand's vulnerability. They identified it. The test for any managed exchange rate you are considering for investment or trading: what does the current account look like, and is it sustainable? What are the reserve levels, and are they rising or falling? What is the banking system's foreign currency exposure? These three questions tell you more about peg sustainability than any government statement ever will. The mind lesson is about contagion and the difference between economic contagion and psychological contagion. The Asian crisis spread partly because of real economic linkages, trade relationships, common creditor banks, shared investor bases. But it spread much faster and much further than economic linkages alone would explain, because of the simultaneous behavior of institutional investors operating under stress. When a fund manager whose portfolio includes Thai, Indonesian, and Korean positions gets a redemption call from investors spooked by the Thai crisis, they sell what they can sell, and they sell Korea alongside Thailand, not because Korea has the same problems as Thailand, but because Korea is liquid and they need to raise cash now. This institutional mechanism, the forced selling of unrelated assets to meet redemptions, triggered by a crisis in a correlated category, is what turned Thailand's specific crisis into a regional catastrophe. In every crisis, identify which of your positions are being sold because they deserve to be sold, and which are being sold because they are liquid and someone needs to raise cash. The second category often creates the best buying opportunities. A Baht, a peg. 13 years of miracle growth built on borrowed dollars and a currency commitment that the market decided in the summer of 1997 was no longer credible. And then the dominoes. Indonesia, South Korea, Malaysia. $600 billion in lost economic output. Suharto's 30-year presidency ended by riots. Korean families handing their gold to their government. A generation of Southeast Asians whose progress toward prosperity was interrupted, sometimes permanently, by a crisis they had no role in creating and no power to prevent. George Soros had not created Thailand's current account deficit, or its banking system's dollar mismatch, or its overbuilt property sector. He had identified the vulnerability and bet on it. He was right. Whether that makes his role in the crisis admirable, deplorable, or merely professional is a question that finance and ethics have been arguing ever since, and that I will leave you to answer for yourself. What is not arguable is the lesson. Fixed exchange rates in a world of free capital flows are a promise that can be broken at any time, by any actor, with sufficient capital and sufficient conviction that the fundamentals don't support the promised rate. The only question is timing, and the timing is determined by whoever runs out of resources first, the central bank defending the peg, or the speculators attacking it. In 1997, in Thailand and across Southeast Asia, the central banks ran out first. Next time on Market Mayhem, 1995 to 2000. The internet was going to change everything. It did. But that true fact was used to justify valuations so disconnected from any business reality that when they finally corrected, $5 trillion disappeared. Pets.com and $1 trillion of hope. The dot-com bubble. Episode 13. If today's story changed the way you think about currency risk, structural vulnerability, and what it means when the market decides a peg is unsustainable, take the free mind, method, money assessment at CompleteTradersEdge.com/assessment. Links in the description. Subscribe so you don't miss the next disaster.